So we will do the past paper today. I will start with September 2019 paper, which was the first paper prior to the last exam, because I don't have the last exam paper yet. So I will do that. Then I will try to do the March paper as well if time permits. Right? Then we will be having a revision class on 22nd and 23rd of May. I don't know how to register for that. Please contact the institute on that. Right? Am I clear? Can you hear me properly? Okay, Sanjeev, thanks. Now, yeah, this is the September paper, right? Can you see the board when I put the presentation? Is it fully clear? Okay. So, like we have question paper comes with 10 MCQs and another 7 questions rather, right? So try to capture the maximum marks from the MCQs. These MCQs, they are giving answers, at least 2 answers are very similar. So be careful, but these are not difficult questions. Why is the source of customers' contribution to the total amount required important in business lending? Right? The question is, why is the source of customers' contribution to the total amount required important in business lending? What are we talking here? We are talking about customers' contribution, right? So when we are looking at customers' contribution, we are talking about customers coming out of 5 C's of credit: character, capital, capacity, condition, and collateral, right? Capital we are talking about.
Excuse me, sir. Sir, is it September 2019 or March 2019, sir?
This September 2019.
But we are having March 1, no, sir?
I have put the March one as well, so I'll do the latest one, then I'll go to the later one.
Okay, thank you, sir.
Right? So here we are talking about the capital, right? That is the contribution by the sponsor. It can be for a project or it can be for the entire business. Right? So the question answers given, it reflects his honesty or dishonesty. That is character basically. It may disclose unexpected factors about his private life. Again, it is character. It may give an indication about his ability to save out of income. Like all money, his contribution has to come from savings. So you have profitable business, so you have some profit to save. It may disclose borrowings from elsewhere. That is not capital. Again, that is lending part. So answer would be C. As indicated, it is the C. Because it may give an indication about his ability to save out of income. First two speaks about character. Last one talks about the lending part, right? So the answer is C. When it goes to second one, in the absence of a very strong credit policy guidelines and credit procedure manual in a financial institution. What is the credit policy guideline? It is the top level direction given by the board of directors to do the credit, right? So credit officers can grant loans and advances with confidence. When you don't have a direction, can the credit officers be confident? No. Recovery of non-performing loans would be in greater challenges. When you don't have a guideline, we can lend for very risky things. So your NPAs will be high. So the recovery department will have a much higher challenge. It is a reflection of value-driven culture. What is value-driven culture? It is quality portfolio. Value-driven means we are looking at quality portfolios only. Credit officers would attempt to take undue risk in lending, right? So look at B and D. Both are almost similar. When you don't have a proper guideline, credit officers can bring weak deals, right? However, approving authority is there. Therefore, whatever brings in, approving authority has to scrutinize. Therefore, the better answer would be B, right? Then we go to the third one. Which statement is more accurate in terms of credit moratorium granted to a customer by a financial institution? We have two words, grace period and moratorium. When you talk about grace period, normally it is capital you don't have to pay, interest you have to pay. If you just say moratorium, it is normally capital and interest both we don't pay, right? But lately we started talking about capital moratorium, interest moratorium separately, but normally it is moratorium, which is accurate in terms of moratorium granted to customers for financial institution. Customer can refrain from paying loan, capital and interest during a given period. So they don't pay interest, they don't pay capital. Customer can refrain from paying loan, capital and interest during the entire period of the loan. See, if you miss the two differences, given period and entire period of the loan, if you do a silly mistake, you will be in trap. So answer is A. Second one is similar to A. Customer can refrain from paying only capital payment during the given period of time. That we talk about grace period. If they say capital moratorium, this is same. Oh, good. Customer can pay loan, capital and interest as he wishes. That is nothing to do with grace periods or repayment. That is the repayment structure we may give to a customer. Cash flow is recognized as the source of repayment of any credit facility. What evidence of cash flow a credit officer should look more in a credit application received from an individual, personal customer who is employed? It's a personal customer, employed personal customer. What should we look at with a higher weight, right? Whether the applicant is permanent employee, right? Because temporary employees or contract employees can be disengaged at any time. So you need to know whether this customer is permanent. The amount of gross and net salary, that shows the cash flow. Gross salary, total deduction and the net salary. So that is the same thing as B. Strength of the cash flows of the employer first, right? You can be permanent employee, but if you are working in a weak company, you have a good salary, permanent employee, but employer is a weak one, then you will have issues. So when you are talking about salary-based lending, you have to look at where this customer is working first, whether it is a good company or not, right? That is the answer. 5, a current ratio in a business is exceeding 1:5 may indicate, that means 1 rupee of current liabilities is covered by 5 rupees of current assets, right? Give me 1 minute, please. Give me 1 minute. Sorry. A current ratio in a business exceeding 1:5. That means 1 rupee of current liabilities are covered by 5 rupees of current assets, right? So you have a lot of current assets to cover the current liabilities. Excellent stock control. If you have excellent stock control, current liabilities so high, is it okay? Unprofitable use of liquidity, right? Liquidity is short-term borrowings types. Excellent credit control, that means collection of credit. Liquidity problem. Don't see a liquidity, but you can't predict on that. It can be unprofitable use of liquidity. That means you are not utilizing your ability for short-term borrowing for your business. You have funded mainly from long-term funding, that is equity or term loan, right? Normally it should be 1:2. That is a better way of managing, because look at the board, right? We have fixed assets, current assets, which is inventory, debtors, cash, current liabilities, which is creditors, short-term and PODs, net assets, share capital, reserves, net worth, term loans, total capital, right? So current assets and current liabilities. This is working capital, short-term assets and short-term borrowings. Inventory, debtors. Normally, inventory should be financed by creditors. Major portion of inventory. Debtors should be financed by this one. Short-term facility, major portion. Right? So, when you talk about current assets and current liabilities, we'll talk about liquidity. Right? This one, which is equity capital, which is debt capital, we talk about, when you talk about this, it is the leverage ratio. Right? Current assets minus current liabilities is called working capital. Right? That is the portion we have financed from these two. This is net working capital. Okay. Current assets minus current liabilities. That is the portion which you have financed through loan. On the working capital, yeah. එතකොට අර ලියන්න පුළුවන්. එතකොට මේ පේන්න දාන්න. Right, so it is like this. So basically, you have to have a good idea on the P&L and balance sheet always. How it happens is, see, this is a cash eater. Then again, this is a cash eater. Right? You get funds from this. You get funds from this. You get funds from this. Right? These are negative funding. These are positive. Then from this one also you get positive. That is a delay in payment. So what happens? You get a short-term facility. You increase your cash position. You buy inventory. You reduce your cash position. When you sell inventory, you reduce your inventory position and increase your debtor position. When you collect your debtor, you reduce your debtor position and increase your cash position. When you have a lot of cash, you can settle your short-term facility. So it is a circle. Right? So always PODs and short-term facilities are settled by liquidating current assets. Only the interest portion is settled by the P&L profitability. Why? Whenever you settle a short term, you can retake it and continue this process. Right? However, on a term loan, if you settle, you can't retake that part. Therefore, term loans are settled by P&L profitability. This one settled by liquidating current assets. Right? Short terms are settled by liquidating current assets. So always you calculate interest cover ratio to find out short-term facility repayment ability, whereas long-term facility repayment ability is calculated using DSCR. This is the basic of balance sheet and the P&L, right? Am I clear to you? Can we go to the questions? Can I go to the questions, please? Right. So current ratio is in a current ratio in the business in excess of 1.5, 1:5. That means you have used lot of your long-term funding to finance current ratio. You have not utilized your creditors. You have not utilized your short-term facilities. When you can borrow, take credit period without increasing your cost, that's good. You are not using your money, you are using others' money, right? Credit risk is best defined by which of the following statements? Credit risk is, will my customer pay me back as agreed? When they don't pay, my profitability, my value of the company fluctuates, right? Profitability of non-payment or delayed payment by loan customer. Delayed payment is not credit risk, that is liquidity risk. Inability of customers to repay the loan obtained from financial institution. So it goes in line. Losses arising from non-performing loans in a financial institution. That is a loss. Then, because we are talking about credit risk, potential variation in financial institutions' net income and market value of equity resulting from customers' non-payment or delayed payment of loans and advances. That is the potential. Risk is a potential thing, right? So answer would be D. A measure of a healthy gross profit ratio of a business entity indicates that, right? Look at the board again. You can see this part, right? Turnover, direct cost, raw material, labor, electricity, gross profit, admin, overhead, selling, overhead, finance, overhead, profit before interest and depreciation, interest, depreciation, operating profit, other income, net profit. This is the P&L, right? Turnover comes with price into quantity, right? In general business, any change in these three, that is the direct cost of a business, can be passed to the customer through price, right? In general business scenario, any change in raw material, labor and electricity can be passed to the customer through price. Why? If I am a manufacturer of bread, price increase in flour will affect entire population of bakery people. Therefore, everyone will face the problem, so everyone will increase. But if there is an increase in these things, you can't do the same thing. Why? These items are only for my problems. These are my problems only. Whether you are hiring a 500,000 salary manager or 100,000 salary manager is my decision. So because of that, if there is a cost increase, you have to bear, not the customer. Right? So remember this, gross profit won't change year on year. It shows efficiency. If you are doing a good product and marketable product, whenever there is a direct cost increase, you can pass. If you are selling a bad product, market does not want and don't like it, you can't do this. Because if you increase your price with other, they will not buy because your product is bad. Right? So always any increase, if you are an acceptable market player, if a product is an acceptable product, any change in these can be passed from that. However, these things can't be passed. Profit before interest and depreciation. Any income which is generated outside your main course of business is other income. If you are a printer, income from printing comes here. Sale of cut pieces of cardboard goes there. Right? The question is, a measure of a healthy gross profit ratio of a business entity indicates company is able to sell its goods profitably than others. You can't say that. You don't know. Percentage of sales exceeds the cost of goods. You have a gross profit means you have a profit over the direct cost. A company can efficiently sell its products or services efficiently. Whenever there is a cost increase, you just pass it. Company is able to purchase its goods at a low cost. Right? So again, that is raw material cost. We don't know whether it is low or not. So answer would be C. Write the formula for debt service cover ratio. Right? Profit after tax, which I taught you in the class, is DSCR equal PBID minus tax divided by capital term loan plus interest term loan and short term plus lease rentals. Answer has been given as profit after tax plus interest plus depreciation divided by the same thing like this. Right? Profit before interest and depreciation, I took this one, which is after these two, prior to these two, and deducted tax here. They have taken the profit after deducting the tax and added back these two. In that process, they have taken other income if there is. Right? So you can use the same thing. Both ways, both are correct. Right? Other income is a fluctuating thing. So normally we go for PBID minus. So you write that one also, you are correct. Profit after tax plus depreciation plus interest, loan capital, interest and leases. When you talk about interest, the entire interest. Write 4 features of overdraft facility granted for business organization. Overdraft is a limit marked on top of your credit balance in your current account, right? And you can reuse. It is granted for revolving working capital return. You can reuse. Should be paid on demand. Overdraft is a demand. Whenever bank demand, you have to pay. Generally extended for period of all short-term facilities are extended for 12 months period, which is renewable. It has a maximum credit limit and beyond which is temporary overdraft. POD, permanent overdraft, is a limit marked over and above your credit balance in the current account. So we say we mark a 1 million POD. If it is 1.1, POD limit exceed by 100,000. It is a TO, temporary overdraft. Interest should be serviced during the period. In overdrafts, you don't need to pay the capital, only the interest need to be serviced. That means you can take out the money, don't send anything. Still, you can wait just paying interest. Mostly should be secured, not always, with acceptable securities, mostly property securities. Amount is determined based on the working capital requirement. Any short-term facility amount is decided by the working capital requirements. What is the meaning of capital in credit principles? Capital is owner's funds. Contribution of the customer to the loan or the project. Amount of reserve in the business, that is the net worth and reserves altogether. How risky is the business in terms of financial leverage? Larger the gearing ratio, high would be the financial risk, because the money you earn, major portion you need to allocate for debt servicing, right? How solvent the business is, that is the gearing, long-term debt and long-term capital part. So that counts for 10 small questions, which is 20 marks. So try to capture the maximum on this. Any questions? Any questions? didn't answer my previous question as well. Sanjeev has answered that. Yeah. Are you there? Can I proceed? Thank you, Sanjeev. You are the only one answering. Okay. Thank you. Where is it? Right. Credit policy guidelines are very important, not only for developing standardized credit evaluation process of the financial institution, but also for the developing a robust credit culture, within which the credit officers would make their own judgment with confidence. Right? Okay, we'll go this way. Name the basic steps in typical business credit process. Business development. You have to develop, remember the graph I drew on the board, starting from loan origination to ending full recovery, like an umbrella, which is the credit policy. So you need to do the business development and credit marketing. You go out, develop the business, get the documents, and come for the credit evaluation. Then we do the evaluation part. You evaluate and prepare the memorandum for the approval. Once approved, credit admin part starts. They have to do the offer letters, get the mortgage bonds prepared, right? That is perfecting the documents. Perfecting the credit means preparation of offer letters, getting them signed, right? And secured documentation is the mortgage bonds and liens and all those things. Then you have to get the commitment. Then you go to limit setup. Approval conditions, offer letter condition, both should be same, and that should be replicated in our core banking system. So that is limit setup. Right? Then you do the disbursement. Once you do the disbursement, you have to monitor the credit till the full collection of that money. So covenant monitoring will be there. What are covenants? You have two types, positive and negative, or affirmative or restrictive covenants. Affirmative covenants, you ask the customer to adhere to, provide bank statements, provide financial information. Restrictive covenants, you restrict the customer's actions. You can't borrow, that kind of. So you need to monitor the compliance to these covenants. Right? That is credit monitoring. So you start with credit development and credit marketing, analyze, evaluate and bring the credit report for approval, approve, then comes the CAU, credit execution and credit administration. That means you approve, get the offer letter, sign, bring it back, limit setup, disburse. Once disbursed, you start monitoring till the end collection. So credit monitoring and follow-up is outcome is the review of credit governance and the process of loan service and take initiative upon if any deviation. Covenants are breached, you take action. Payments are delayed, you take action. That one, right? Name the steps. Basically, it is our credit life. Explain the main function of business credit evaluation process. How to evaluate a business. Collect information for the credit file. Right? You have to collect. Then first you have to collect information. Then you have to evaluate the external and internal factors like industry, management, evaluate the internal and external factors, then evaluate the financial, then evaluate the credit requirement, what is the purpose, investment or working capital, then look at what is the contribution from the borrower and the ability to service. Then once you know, okay, this is the requirement of the loan, firstly you look at whether this business is in good industry and is the business managed by good people. Then you look at their past performance and project the future. Then you look at what is the purpose of this loan, for working capital or investment, right? Based on the borrow projections, can this customer pay? When we see customer can pay, we look at second way out. First way out is always cash flow. Second way out would be a security realization. For that, you evaluate the security, collateral. Then write the summary, which is the appraisal paper, and recommend. So your question is, explain the main functions of credit evaluation process. Collect information, look at the external and internal factors, financials, for what purpose, projections, debt service ability, security evaluation, final evaluation, and goes for approval. So this is your day-to-day life. Third, difference between loans and advances. Loans are long-term funding, advances are short-term funding. Limits. Loans, investment, advances, working capital, repayment generally above 1 year, advances less than 1 year. Repayment, projected cash flow, advances, expected known cash flows because short term. Debt service cover, interest service cover. NPL recognition, default of the 3 installments, default after 90 days. This was the earlier. Now anything 90 days, it will go to NPL. Whether it is long term, short term, whatever. Examples, term loans, project loans, overdraft. Try to give examples as much as possible. Then they know that, examiner knows that you know, right? Don't try to write lot of things. When you start writing lot of things, your focus will be lost. Then you write something irrelevant, your marks will be deducted on that. Describe the importance of banks' credit culture in managing credit risk. Right? Credit culture. That is how management look at credit, right? Then we have 3 types of credit culture. Okay. Value driven, profit driven, market share driven. Right? These are the 3 cultures. Value driven, we look at the quality of the portfolio. Short-term profit driven, current profit driven. We want profitability is the key. Market share, good and bad, everyone need to be in my books. So we talk about describe the importance of banks' credit culture in managing credit risk. When you take these three cultures, market share and current profit driven is risk prone. Value driven, it is lending purely based on principles. Your aim is to keep the minimum NPL ratio. You want quality portfolios. In that kind of a scenario, your profit would be lower. Why? You are trying to capture only the best people. The principle we operate is risk return trade-off. Higher the risk, higher the return, lower the risk, lower the return. See, TODs, which are clean bay granted facilities, decision taken within 1 or 2 minutes. That kind of things are going on high rates, 24%, 18%. Credit cards, clean basis, 18%. Whereas today, our lending goes around 10, still 8% margin because it is high risk. Higher the return, higher the risk, higher the return. Under value-driven culture, it is low risk. Then in a bad time or good time, your recovery would be better, consistent. The bank management credit philosophy determine how much risk the bank will take and in what form. That is credit culture. A bank's credit culture refers to the fundamental principles that drive lending activities and how management analyze risk. There are 3 different cultures. These are the 3 different. Then we talk about value-driven culture because we talk about the risk there. Focus on credit principles and do not under risk. Do not take undue risk, whereas other cultures take high risk for profits. Therefore, if the bank that are established value-driven culture could minimize credit losses even in unhealthy economic conditions. Others need to suffer.
So what are the other 2 credit cultures except value-driven?
Okay, it is value-driven, current profit-driven, and market share-driven. Current profit-driven, as I explained, current profit is we are looking at profits. First thinking is I need to have profit this year. If something goes bad, we look at it separately. So in that case, what happens? We tend to give lot of clean facilities, right? Credit cards, TODs, all those things. Market share is I want everyone to be in my books. Whether they are good people or bad people, everyone needs to be in my books. So for those 3 cultures are high risk. Value-driven culture is low risk because there it is only based on principles, right? So we try to attract the best people in the market, then our margins would be smaller. Okay. Right. Value-driven culture leads to sustainability in banks due principles-based lending practices because it is purely based on lending practices and principles. You don't take risk. No TODs, no credit cards. If given credit cards, only to the best people. Appraising a credit proposal is imperative not only for profitability of the financial institution, but also for the risk mitigation. Careful examination of credit proposal is in the credit proposal is the credit appraisal. The knowledge about the credit analysis techniques is imperative in this regard. Discuss the risk of lending to tourism industry as the backdrop of global and local external environmental conditions by using pest analysis. This is what we use, PESTLE. They have taken out L and E, legal and environment, right? Political, economical, social, and technological analysis. Using this PEST, these 4 angles, you have to discuss the tourism industry. PEST is political. Political is policy changes, strategic initiatives. That means how the political environment encourage the tourism business, right? Because tourism business is a very critical business to the country economy. So political willingness is there to attract tourists to the country. So visa policies and all things are coming from political influence. Mostly related policy changes and strategic initiative taken to develop the industry by the government. One time we were designated as a low-end tourist designation. Then current Tourist Development Authority want to mark us as a high-end tourist. Like the tourist who goes to Egypt and tourist who goes to Maldives and who comes to Sri Lanka, 3 different. Forget about Egypt, Maldives and Sri Lanka is 2 different categories. Maldives is high-end tourist destination. In Sri Lanka, it is not high-end. It is a middle and to low-end, backpacker to middle income. So, but our current authorities, they want to pick this to high-end, because when you attract high-end, your spending in the country would be higher. And that is the political factors. Government take initiative, special to at the backdrop of April and the COVID now, rebuild the industry. But because with the COVID and other issues, we can't go. Like when you have red alerts, people will not travel to those destinations. Sri Lanka does not have. Earlier we had. Economic factors, tourist spending power in global context is a key factor in it. So when you talk about tourism, foreign tourism and local tourism, when you don't, spending power of the people who are coming in, who are traveling, is the key factor in economic side. Whether the foreigners who are coming here has the spending power. When you go and speak to some hotels, they say people coming from this part of the world is useless because they don't spend. They come for the package, they eat, they drink only what allowed in the package. Even a local tourist goes in, our spending is much higher than those people. That kind of a thing. So that is the ability to spend, whether it is local or foreign. So when the foreign ability is coming down, we need to develop the local tourism. Social, cultural, normally we are very open to attract tourists, right? So there is no social barriers. That kind of thing you have to discuss here. Then technological factors, online bookings, online visa, connectivity, all those things we have to have, which is available and improving in our country now. So it is a low risk one. Social cultural factors are encouraging. We are happy to welcome people. We are happy to show our things, that kind of a thing. So based on the fact industry they are asking, these factors you have to discuss. Then they have given a P&L and balance sheet. This is the P&L. This is the balance sheet. And they are going to ask questions. Comment on the progress of business in terms of sales growth, gross profit, and net profit. Always try to comment on the growth, right? Sales volumes, which was 7.2, has gone to 9.1. Calculate the percentage and say sales has grown from this figure to this figure. In absolute terms, it has increased by almost 2 billion. 1.9 billion, it has increased. So you have to write. If you know the reason why it has gone, you have to comment on that as well. Right? Look at this. Increase of sales volume is 25.91, is very positive, along with the large volume of 1.9 billion increase. Tell the growth, tell the volume, absolute growth as well. Then the cost of sale. So you talk about when they ask comment on the progress of business in terms of sales growth, gross profit, and net profit. Right? Go line by line. First, they're asking about the sales. Then you comment on the cost of sales. Then you comment on the gross profit. Then you comment on the net profit. This one, these two. Right? Cost of sales as percentage of sales is steady in both years. One year is 60, next year it is 59. So it is almost the same. That means there is no bigger increase in cost. If there is an increase, it has been passed to the customer through the pricing, which is a reflection of competitive pricing on both sales and purchase, is not subject to external factors, right? So if there is a change, you have increase, right? So cost and the sales both has gone the same way. Gross profit margin are steady. Because of that, gross profit margins are steady on the both years. Then steady raw material cost, steady direct cost, steady gross profit margin as a result of increase in sales, while cost of sales is at same level, gross profit volume has increased. That's the margin, this is the volume, right? Volume has grown by 23%. That means difference between these two, 3.661 minus 2.964 divided by 2.964, right? Always percentage and absolute term, both you discuss. This is the absolute term, this is the percentage term. This growth momentum has resulted in net profit volume increase by 48%. It's not the margin, it is the volume, absolute terms, right? Listen to this, we'll see, almost 50% growth, 800 to this. Let's see how much it is. %, like this minus this, net profit minus 828, 1193 minus 828 divided by 828 is 44%, 300 plus million. See this one. This is a support. This is supported with steady and effective cost management in both administration production and sales expenses. That is this part. Administration. See, the growth is small. It is only less than 200 million. This one here, again, 150. This is also 150. This is higher growth. Then we go to company has experienced a decline in current assets in 2018. What would be the possible reasons? Let's go there. See, current assets were 9.1. Right? Current assets in 2017, it was 9.122. Now it has come down to 7.104. That means almost 2 billion, 200,000 million drop. How has it happened? Inventory, it has grown, improved from 941 to 1.190. That means 200, almost 200 million growth there. That means money has been invested there, right? Then trade and other receivables, it has increased from 3.1 to 3.7. That means basically 500 million increase there. However, your cash position has come down by almost 2 billion. 4.8 has come down to 1.8. Earlier, from this one, .48, you can't see, no? Right. 4833 has come down to 1928, which is almost 2 billion drop. Out of that 2 billion, inventory has gone up by 200,000, 200 million. Trade has gone up by 500. So it is 1.5 million left again. That means it has gone somewhere else, current assets. Money has gone out somewhere else. 1.2. See, your interest bearing loans and liabilities has come down from 1.5 to 0. That means that money which was as cash has come down, used to repay your loans. That's why your current asset has come down. Out of the 2 billion, out of the 2 billion, cash dropped. 700 you can justify saying that it has been used for the stocks or debtors. However, balance part, it has to go somewhere else. Inventory has gone up. Sorry, non-current asset has gone up by almost 1 billion. Your short-term loans has come down by 1.5 million. Long-term liabilities not given. Is given. Non-current liabilities 300 to 2. That is only 100 million increase. Right? So the money from current assets has mainly gone to reduce this one. Interest bearing loans and liabilities 1.5 to 0. So that should be your answer. Current assets have been decreased by 2 billion. This is mainly due to decrease in cash equivalent. Most possible reason would be full settlement of interest bearing loans. Other reasons for decrease in cash and cash equivalent may be increase in inventory and trade receivables because of expected cash collection has not been collected. That is regarding the trade receivable. Other possible reason may be investment in non-current assets. Right? Some part has gone there, some part has come down. Calculate the current ratio and comment on the efficiency of managing their current assets. 2018, it was 1 rupee of current liabilities are covered by 8.36 rupees of current assets. Whereas 2017, it was 1 rupee of current liabilities covered by 4.04 current assets. That means during 2017, customer has utilized his short-term funding to fund the current assets. Whereas in the 2018 year, customer has utilized his own funds, capital and long-term funding to finance the working capital. That's why coverage has gone up. See, earlier current liabilities were 2.2, it has come down to 800,000. That means he has been using his own funds and the long-term funding to finance the current part, which is not good practice. Good practice is to have 1:2. 1 rupee of current liability should be covered by 2 rupees of current assets. So it is not an efficient way. Efficient way is to use your current liabilities to fund the current asset. Creditors should fund the inventory. Debtors should be funded by the working capital loans, short-term funding. Let's see the answer. Current assets have been decreased by 2. We discussed that. Current ratio is this. Generally, current ratio around 2 times is much better. Current ratio less than 2 is risky. Less than 2 is risky because you need to have a cover, because inventory can't be converted to cash very fast, and creditors also collection would be difficult. Current ratio less than 2 is risky, and more than 2 is reflection of inefficient management of current assets. Company has mostly used its equity for financing working capital expect in 2017. 2017 they have used short-term funding, but 2018 they have used equity and long-term funding. Excess cash would have been invested in income earning assets, long-term assets. Inventory would have been ideally financed by the supplier credit. Debtor would have been financed from bank advances. Question number 4. What's the time? 11:40. Asset financed by financial institution extend not only to business purposes but also retail purposes. Discuss the following 4 types of assets finance loan schemes under the purpose, repayment period, means of recovery, and determination of repayment capacity. I have given you a handout which discuss different products. Right? Go through those things. Housing loan, purpose, purchase of land, building, house construction, renovation, anything. Repayment period, it is normally long term, 5 years and more. Means of recovery period based on the salary repayment. Repayment capacity, it is the debt service cover ratio, or sometimes we take 40% of take home salary. Project loans, it is the purpose to finance fixed assets and permanent working capital, because working capital is permanent and variable. Permanent part need to be financed by long-term funding. Repayment period more than 1 year, but we don't give 25 years, 15 years. Means of recovery, projected cash flows. Means of recovery, projected cash flow. Project loans are loans granted based on the projected cash flow without considering the balance sheet of the sponsors. Repayment capacity, debt service cover calculation. We calculate IRR, NPV, those things. Project viability. Working capital loans, financing the permanent. Working capital, if we talk about working capital facilities, it is short term. Right? But if it is working capital loan, it is permanent working capital. Repayment period normally 1 year to 3 years. Can be go to 5, but it is normally 3 years. Means of recovery, profit generation from sales conversion. Repayment capacity, again debt service cover. Financial leases, acquiring assets. Lifetime repayment period, if it is 5 year, 5-year term. If it is 4 years, 4-year term. Normally 4 to 5 years. Now we go to 6 to 7 years as well, but normally it is 5 years. Means of recovery, cash flows from the business. Again, repayment capacity is the debt service cover ratio. Working capital financing. Look at the board. Current assets minus current liabilities is working capital, right? You can see this part. If you take time, value, right? With time, normally fixed assets increases, right? Because we expect business to grow. This is business life cycle, right? Time, value, right? Business grows like this. This is the declining phase. You have to diversify. Okay. So with time, fixed assets grow like this. Similarly, permanent working capital also grow like this with time. There is another part which is the variable on top. So fixed assets, permanent working capital, variable working capital. This should be financed by long-term funding. The balance part should be financed by short-term funding. Entire of variable working capital and part of the permanent working capital. What is the permanent working capital? It is the minimum level of stocks, minimum level of debtors in order to run the business. We say I am a manufacturer of shirts. I can't run to the market, bring clothes, cut, chop, sew and sell. You need to have a minimum level of stocks. Once you sell, I will not get my money entirely. There will be some part always there in the market. That is the minimum level of debtors in the market. First day I am going to the market, I am giving to everyone. Second day, I will collect that, but I have to give more. So always there will be some money invested in the market. In my normal course of business, I will have minimum level of stocks and minimal level of investment in the market. Both of them need to be financed by long-term funding. It can be equity, it can be long-term borrowing. Above that, money we need to get additional stock. Money we need during these days because the festival season is coming. Those things are financed by short-term facility. Right? Permanent and variable working capital are there. With time, fixed asset increase because we expect the business to grow like that. When your operation increases, permanent working capital level increases. Variable also increases. Explain how companies' permanent working capital needs differ from its temporary. Permanent working capital is the minimum level of current assets which is continuously required by a firm for carrying out its business activities, and that cannot be converted into cash in normal course of the business because it is always there. If you are stopping, you can sell that part and convert to cash. You can collect everything and stop your business. So it is not permanent course of business. Permanent working capital is either constant or it increases with the size of the business or its scale of operation. That's what I showed you in the graph. Characteristics: continue to exist for long period of time in the business activity, constantly changing in the business from one asset to other, inventory, stock, cash, again inventory, stock, inventory, debtors, cash. So with that, it goes up and down. Grow the size or volume of business operation. Any amount over and above the permanent level working capital is temporary working capital. It keeps on fluctuating from time to time as per the changes in the product and sales activity. Volume increases, your operation increases, volume of sales increases, operation increases, permanent working capital increases. It is an extra working capital need to change production and sale activity. Your raw material stock increases. It creates to meet liquidity requirement. So that is funded by long-term funding. So your liquidity goes up. Current assets minus current liabilities, that part. It fluctuates according to the level of operation. Higher the operation, higher the permanent. Remember the graph always. How can a company be benefited from maximizing the use of trade credit? What is trade credit? Trade credit is getting your raw material or your intermittent product or your product without paying. You go to the market, purchase goods, but you don't pay. You issue a post-dated check. You issue an instrument, but you don't use your money. Right? So you are not investing your money. You are using someone else's money to operate your business. Right? But if that free goods comes with additional cost, then no point using that. It's better. Always you have to check what is your cash margin. Like if I pay you cash, what is the price you give? If I take 1 month credit, what is the price you give? We say if you pay cash, I am giving you 100 rupees a kilo. But if you don't pay cash, I am giving you 110 rupees a kilo. That indicates 10% charge. If you can borrow at 5%, it is better to borrow and pay cash. But if your borrowing cost is 15%, it is better to take credit from the suppliers and not to borrow. Right? See the calculation. Cash flow of the business could be strengthened by obtaining supplier credit because you don't use your money. It is others' money you are using. Company does not have to pay upfront. You are not paying upfront. You are paying later. That's the difference between operating cycle and the cash cycle. That's the credit period. Supply credit is cost effective than any other means of financing of working capital. Company can make use of cash for other investment. When you using supply credit, you can use the cash you generate from the business to do a machine. Company can buy large volume of agreed period of time. When you buy large, you get lower prices, but if effectively moving in the market. Bank borrowing could be avoided or minimized because then you need security, you need your personal commitment and everything. But if you get creditors to fund you, all the hassle goes away. But it has to be at low cost than the bank borrowings. Another question, P&L, they're asking, calculate the stock turnover ratio and stock holding period for the year. I have told you two things. Whenever you are calculating a ratio using figures from the balance sheet and P&L, always take the average on the items you take from balance sheet. P&L figures can be taken as it is. Why? P&L is for a year, but balance sheet is for a day. In order to avoid this timing difference, you use balance sheet figures as average, P&L figures as it is, right? So whenever you are on working capital, you have two things. How does it happen? Raw material period, work in progress, finished goods, and debtors. Right? This is inventory. This is debtors or trade receivables. Right? Then, okay, this is called inventory turnover or inventory turnover period. This period is called debtor turnover or debtor turnover period. This comes in number of days. This is number of times. Right? So inventory turnover period is your question. Inventory turnover equals cost of goods sold divided by average inventory. When you have 2 years, you add the both inventory figures and divide by 2. This gives you how many times per year you convert inventory into sales. How many times per year you convert inventory into sales. Inventory turnover period is average inventory divided by cost of goods sold into 365. This gives you how many days on average you need to convert inventory into sales. This is how many times to convert inventory into sales. This is how many days you need to convert inventory into sales. This comes in number of days. This is times. Right? Your question is this. From that balance sheet, you can take figures and write it here. Then you have similarly debtor turnover. Right? This is credit sales divided by average debtors. How many times per year you collect your debtors? Right? Credit sale. This is credit sale. If they have not given credit sale, you take everything as credit, 100% credit. Debtor collection period equals debtor turnover period or debtor collection period equals average debtors divided by credit sales into 365. Right? This is that. So inventory turnover period plus debtor collection period is called, this is plus, is called operating cycle. Okay. Similarly, you can get credit from the market. So you go to the market, you don't pay, you get your raw material, come back, but after several days, you have to pay. So this is creditors period, right? You go to the market, bring the raw material, but you don't pay. After some number of days, you get to a check coming into the account, so you need to pay, right? So actually speaking, from this date, this is the period you actually invest your money with, right? This is the actual period you invest your money into the working capital. This is called cash cycle. That is operating cycle minus creditor turnover period equal cash cycle. That means you deduct this portion from your operating cycle. How do you calculate creditor turnover period? Creditor turnover equals cost of goods sold divided by average creditors. How many times per annum you pay your creditors? How many times per annum you pay your creditors? Creditor turnover period, that means number of days. Creditor turnover period equals average creditors divided by cost of goods sold into 365. Right? Average creditors, can you see? Average creditors divided by cost of goods sold into 365. Cost of goods sold, average creditors. This one is average creditors divided by cost of goods sold into 365. This is number of days, this is time. Right? Give me a second. Right? Let's go to the question. Stock turnover period, stock holding period. This using the figures from the example. Then we go to question 6. Measuring the risk of any credit facility is imperative for financial institutions to minimize the losses resulting from non-performing loans. Discuss how each of the following helps a financial institution to mitigate the credit risk. Michael Porter's FIFO's analysis. What do you analyze here, Michael Porter? Right? What is it? Rivalry. That is competition. Dependency on buyers. Dependency on sellers, buyers and raw material suppliers, sellers, suppliers. This is entry barriers. This is substitutes. So basically, you are evaluating the industry, strength of the industry, right? Look at tea. Who are the main players in the tea? Who are our buyers? Which countries? Who are the suppliers? Whether the industry supply is good, whether we have enough supplies. Then entry barrier. Can anyone come and open a tea factory? Substitute. Instead of tea, are they going for other drinks? So we are looking at the bigger picture of the industry. Right? That is the Michael Porter's FIFO's model. Porter's FIFO's model is a tool to analyze any industry risk or richness of the industry before investing in. Financial institutions should look at the industry risk before the borrower's risk. First, you should know where this borrower operates, whether it is a good or bad industry. Then you look at the person. Porter's 5 force model is this, right? Could minimize the sector exposure using for sector identification, you use this one. Then we talk about risk rating. What is a risk rating? Risk rating is the probability of default. What is the probability this customer will default? Right? It is only a indication of probability of default of a customer. Under the risk rating, when you are working an internal risk rating, it is qualitative and quantitative factors both you consider, right? So it is operation risk and the credit risk. Risk rating are the primary summary indicator of the risk for banks' individual credit exposures. Each and every individual need to be rated. Well-managed credit risk rating system from bank safety and soundness of facilitating information decisions. That means when you have a proper risk rating system, you know how your portfolio grows. AAA to D is the rating scale. When you have AAA, it is very good risk. Very limited risk, good credit. When your rating goes down, that means you are exposing yourselves to risk. So when your low rate portfolio is growing, your entire bank's portfolio is going towards a risk. So bank safety comes there. Then based on all information, you can take a proper decision. Whether you are going for these segments, whether you are going for these sectors with this kind of portfolios, what kind of staff you need, what should be your provisioning strategy, what should be your collection strategy. All those things need to be tackled there. Risk rating system measure credit risk and differentiate individual credits and group of credits by risk they possess. A customers and AAA customers, group of customers with A, group of customers AAA. This allows bank management and examiners to monitor changes and trends in risk levels. Top management will look at the change in risk levels. CBSL monitors will bank supervision will look at the changes in risk profile. The process also allows bank managers to make risk to optimize the return. We say you have very good portfolio, so you can take a risk of giving some clean portfolios and take higher returns. If your entire portfolio is bad, you can't enhance it. General risk rating covers two aspects: operation risk and the financial risk. Risk is defined in level based on internal rating model, A to AAA to D. Based on that, you can, and AAA may have a 0.01%, D has a 2%, like that. Loan covenants, I discussed this earlier today as well. Two types: positive covenants or negative covenants, affirmative covenants or restrictive covenants. Affirmative covenants are covenants the customer can adhere to: submission of bank statements, submission of financials, maintaining of 1.2 times asset cover, all those things. Restrictive, you can't borrow. You should not invest without asking the bank, that kind of thing. Restrictive is to control the customer. Affirmative is to monitor the customer. That is what they have asked. obtaining collateral, right? Characteristics of collateral: stable value collateral, reducing value, increasing value, and fluctuating value. Cash, land, machinery, stocks. Right? Fixed asset, though the purchasing power goes down, value of the FD remains same. Land, day by day, value increases. Machinery, gradually value decreases. Stocks, some day it is high value, next day it is low value. If you take risk and time, risk, time, it is like this. With time, risk increases. So always it is better to have a link between this and this. Right? Collateral is a secondary way out. Always primary way out for a facility is cash flow. Whether this customer can pay. If the customer can pay based on the feasibility of the business, you decide to grant. Once you decide to grant a facility based on the cash flows, you look at your second way out or fallback situation, that is collateral. Right? So you should never lend thinking that I will have to sell my collateral to recover. Okay. Obtain collateral in asset financing. Role of obtaining collateral in lending is to ensure that second way out, while the first way out is the cash flow. There are two types of collateral, direct and indirect. Direct collateral are what I showed you now. Indirect collaterals are personal guarantees and corporate guarantees. Therefore, in asset financing, it should be direct security, either movable and immovable. Asset financing means long-term financing. So always your risk should match with your collateral type. There are three things how to take. It's a mortgage, pledge, or hypothecation. Mortgage is you mortgage the facility, mortgage the asset to a bank. So in case of a default, you will have to go for parate action or you have to go on mortgage bond action. Pledge is ownership is with the customer, but possession is with the bank. You don't need to go to courts to sell the goods. If the customer does not pay, I can settle. I can sell and settle. Hypothecation, customer, the goods are with the customer. We have given goods on trust, on a charge, on paper. They need to return when the bank asks. If they are not paying, bank should recall the goods. That is hypothecation. We don't do hypothecation now. Normally it is pledge or the mortgage because of difficulty. While financing the asset, obtain the same property as security, ensure that the bank is secured with the risk of lending until the loan is paid off. Loan is paid off, the same property is on security. financial institution also could verify the purpose when assets are taken as security. We take security on the land you are going to purchase, then you can see what is this land, why he is purchasing. If properties are taken as security, impairment, when you have security, impairment is lesser, right? Non-performing asset is defined as a credit. Non-performing asset is defined as a credit facility in respect of which the interest and or installment of principal has remained past due for a specific period of time. What is a SIC business unit? This is the definition: a unit which fails to generate internal surpluses on a continuous basis and depends for its survival on frequent infusion of external capital. That means if a business is making losses continuously and for all their expenses and loan payments, they want external funding, then it is a SIC business unit. Attribute: if the company is unable to pay its debt as they become due in the normal course of business. Loans are getting due, business is not in a position to pay. The value of the company's liabilities are higher because you have to borrow from others and lend. Most of the loans are irregular. They can't pay, therefore loans are irregular. Regular decline in sales. Sales are dropping. That's why the profits are gone now. Increase in the cost of sales because you are making losses. Your short-term lending rates will go up. Creditors will charge higher premium because they are not sure of taking the money back. Continuously loss making. Why should a bank periodically review performance of a business customer? To ensure it is for few reasons. We have to ensure that what we projected and what business actually happening is the same. For that, you need to go and visit and do a periodic review. Then by doing a review, you can make sure that customer is in a position to pay us. And when you go and visit and do reviews, you should identify different factors, whether he's doing any unethical factors, whether he's doing some illegal things which we can't find. Like our bank, we can't finance for tobacco, right? In that case, if a customer I have a customer who has started tobacco processing recently, I can't lend in the future. So if I do a review only, I will know that. Then customer complying with all environmental standard, legal standards. On a review, you can look at that. To ensure the customer is in progress, so that if you do a review only, you can know whether you can relent, you can enhance your exposures. Then the relationship. It's better to go and visit, have a chat with the customer. That's good for the relationships. What early warning signals are evident from SIC business unit? Few things. Individual behavior. Customer comes, when we call, they don't come. Like that, they try to hide from the banks. Individual behavior of the customer with the financial institution and its staff. Behavior of the accounts. Current account turnover comes down, check returns increases, stop payment increases, all those things. In reviewing of financial statement indicates reflected from financial ratio, and like your profit margins are coming down, debtor turnover period increases, stock turnover period increases. When stocks are not there like that, your ratios can be very different. Negative indication from the site visits. You visit, no production, staff is not there, goods are there, but no sales. Like that, you can have no raw material. Those kind of things you can identify. Informal sources. Early warning signals come firstly from the informal sources. It is evident that rescheduled loans are not properly serviced as agreed in most occasions. Therefore, what are the preconditions that should be considered before non-performing business loan is rescheduled? Customer should be very positive. We should not reschedule if the customer is not positive of turning around his business and settling dues and continuing the business. Customer should have operating ability to run the business once the reschedule. We reschedule, give concession, reduce repayments, whatever. After that, he should be able to, whatever the possible cash flows, should be able to tackle that repayment. Customer should be positive, and the current cash flow should be able to absorb the repayment of those things. Business should be viable and there should be a positive cash flows from which the rescheduled loan can be serviced. Customer should not have heavy outside borrowing. Yes, you are going to reschedule, but he has lot of other borrowing which he has not rescheduled. Then it is a problem. New covenant should be feasible, right? When reschedule, you will start new covenants. Those things are feasible covenants. Both parties should genuinely agree to abide by the reschedule letter. Just to avoid NPL, we should not reschedule, and customer also should not sign. If both parties are positive, only we should do the reschedulement. Proper monitoring has to happen. Write short notes on these items. Packing credit facilities. Packing credit facilities are granted for exporters only. Facilities granted for exporters can be classified, packing credit can be classified into pre and post. Normally, we say packing credit for pre-exports financing. But here in this answer, they have to use term packing credit for all the facilities granted to exporters. Working capital financing facilities granted to exporters. Pre-export, that is the money given to finance the raw material and processing part of the business. Right? If you have a purchase order, we lend the direct cost only, while we are giving money to get the goods, process and ship. Once you ship the goods, you discount the e-bill. Those are post-export financing. You discount the bill. You get the original bill, you give money up to the net profit. We never give the net profit to a customer as a discount effect. Pre-export, which is the packing credit part, we use the gross profit margin to decide the percentage to be financed. Post-exports or e-bill financing, we decide based on the net profit. So once you discount, you settle the packing credit, and balance you give it to the customer for other working. It is this what they have written here. Determinants of character of a borrower under credit principles. Crib report, providing financial, tax payment, right? Integrity in terms of providing accurate and actual financial information. Tax details paid to the inland revenue. Facilities reflected in the crib report. details of the facilities obtained from the banking and its behavior, whether they are paying properly. Experience and qualification in subject business. Like if I have been in the business for a longer period of time, normally if you are good only you can survive, otherwise you can't survive. Brand excellence. Your brand has a name, right? Reputation is the most important thing. Capacity of networking, even the how the customer bargain with you indicates the character. Shifting in credit practice most post international financial reporting IRFS 9. Earlier we used to have specific provisioning and general provisioning. From IRFS 9, we shifted to unexpected loss, which is PD, probability of loss, loss given default, LGD, and EL, exposure at default. So with IRFS, we went to impairment. Earlier, we start specific provisioning only when they are in default and NPL. Now from day one, we provide based on our knowledge on the customer. So we have different credit models, different rating schemes. Judgment has a value, whereas previously judgment does not have any value. It is a formula driven, but here based on your knowledge on the customer's ability to repay, you manage your impairment. So that is the difference IFRS 9 brought in. Importance of Credit Information Bureau. It is an independent body. It gives you information about a customer for 24 months. It gives you how they pay, what is the patterns of payment, cash flow difficulties customer face through the check returns, their identification details, and all those things independently they will show. And all the banks are directly linked, real time, not real time. End of the month, all the databases will be updated without the human intervention. So accuracy of data is high. So that is the importance of Credit Bureau. So any banker, in order to ascertain the character, we take the credit risk. That's all. Thank you very much and all the best for the exam. If you join me for the review class, I will brush up again take you through. So we have 2 days. First day I will do the theory part. Second day I will try to do the papers, at least 2 to 3 papers I will try, because you saw that I take at least 2 hours to do 1 paper. So this paper, if there are other people, I will be doing this again. But what I try to do is I will start with March first, then come to this, right? So that's all from me. Hope you have some fair idea. This is very practical. So use whatever the knowledge I gave you and use your practical knowledge and combination you have to write. Thank you very much for everyone participated. Any questions I can answer you.